What do you recommend for the people, for the audience, for your readers of this fine book to do with their money, with their fiat currencies?
Well, that's a great question, and this is in chapter 6 and the conclusion of the book. After we go through the pandemic, the lockdown, the depression, I talk about why monetary policy will not work. They'll do it, but it won't work. Why fiscal policy will not work. They'll do it. They will print money and they will have deficit spending, but don't call it stimulus because it's not going to stimulate anything. And I explain why. But at the end, when we get to asset allocations, I said the first thing I do is I explain my methodology and explain what diversification is. Diversification is a very powerful tool. It does what it's supposed to do, which is increases your total return with less risk. But people don't understand how to diversify. I run into people, they say, well, I'm diversified. I own 30 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, you're not diversified. You may have 30 stocks, but you're in one asset class called stocks. So when stocks are hard, they'll go up together. I'm not saying they won't go, they'll go up together and go down together. So you may have 30 stocks, but you're not diversified. Diversification is, okay, have a slice for stocks. That's fine. Gold, cash, real estate, treasury notes, and alternatives. That is closer to real diversification. So in particular, I recommend about a 10% allocation to gold. And people always want to put words in your mouth. They say, well, Jim Rickards says sell everything and buy gold. I've never said that. I don't believe that. But a 10% allocation, I think, is right. That will, if there is extreme inflation, that will produce gains that are so large, they'll kind of insulate the rest of your portfolio. So you're protected that way. And if there's a loss of confidence in the dollar or some kind of currency collapse, again, gold will do very well. I also recommend 10-year treasury notes, or for the German investor, bonds, 10-year bonds. And the reason for that is, first of all, they're high credit, they're liquid, but interest rates are going to go lower, which produces capital gains. It's a little bit counterintuitive. People don't understand bond math, but it's pretty simple. If interest rates go down, the value goes up. So as interest rates go down, you're getting more capital gains. So we have a lot of, very smart, very prominent people in the United States, Jeff Gundlach, Bill Gross, Dan Isaacson at PIMCO, and others who say, the interest rates are too low. This is the greatest bond market bubble in history. Short the bond market, et cetera. One by one, they've been carried out feet first. They've been wrong about that. And the reason is they confuse real rates and nominal rates. So nominal rates, that's the rate you see on television or when you look at a screen. That's the nominal rate. But the real rate is the nominal rate minus inflation. And the problem is nominal rates are low. That's true, but real rates are not low. I borrowed money in 1980 at 13%. That was my first mortgage. My mother cried because her first mortgage was 2%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%. So my real rate was -2. Plus taxes were 50%, 50, and my interest was tax deductible. So I got a tax benefit on the money I was paying of 50% on the 13%. So that's another 7%, 7.5%. So my after-tax rate, after inflation, after taxes, my real rate was -8. So I was borrowing at 13 nominally, but my real rate after taxes and inflation was -8. That's a low real rate. But the point is that that's where we have to get to. If you want to stimulate the economy and borrowing and lending and spending and investment, et cetera, you have to get real rates much lower than they are right now. Well, we're not getting inflation. Eventually we may, down the road we may, but not now. Deflation is a greater danger. So if inflation is declining, we're getting disinflation and deflation, and the nominal rate is here. How low does the nominal rate have to go to get to a negative real rate? Well, it's got to go negative. It's got to go maybe -2 or -3. That will produce enormous capital gains for the bondholders.
Yeah, and all this cheap money will definitely go into stock markets, in real estate, in other asset classes like, I don't know, Bitcoin, gold, silver, and the central banks are actually in a vicious cycle. They can never get out, actually, because if they raise the interest rates, then I think the economies will collapse. We will see a slowing economy and all the debts. We have debts like never before. But I have the feeling that the medicine isn't really working in the last couple of decades. It's getting less and less effective. Or what's your point on this?
Well, I agree with that completely. This to take it a step further, we can explain why. So let's just talk about monetary policy. So going back to 2008, at the beginning of the global financial crisis, the Federal Reserve balance sheet was about $800 billion. Today, it's $7.5 trillion.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
Meaning in the last 12 years, they've printed almost $7 trillion of new money. Well, where's the inflation? We don't have any inflation in the United States. Now, you do see asset bubbles, but asset bubbles are different. So stock market bubbles and property bubbles, yes. But consumer price inflation, what people pay, clothing's going down, technology's going down, televisions, travel.
Inflation. Yeah.
Yeah, that's deflation. Now, some things are going up, sure, tuition, but when you look at the whole basket, we have no inflation, about 1.5%. But this isn't 3, 4, 5% inflation. We just don't have it. Why can you print $7 trillion and not get any inflation? Because Milton Friedman and the monetarists and the Austrian school and the neo-Keynesians would all say we have to have inflation, and we don't. The answer is money printing has nothing to do with inflation. Money printing does not cause inflation. It's velocity. It's the turnover of money. So I tell people, that's, if I go out to dinner and I tip the waitress and she takes her tip money and takes a taxi home, and the taxi driver puts gas in his car, my money has velocity of 3. My $1 supported $3 of goods and services. That's velocity of 3. But if I stay home and watch television, my money has velocity of 0 because I didn't spend any money. And I tell people $7 trillion times 0 is 0. If you don't have velocity, you don't have an economy.
Yeah.
Velocity is psychological. It's behavioral. How do you feel? How do I feel? Do we want to go out and take our friends to dinner and drinks on us, or do we want to stay home and watch TV? Right now, people are not going out. They're saving. And if you lost your job, you're definitely saving more. But even if you didn't lose your job, there's something called precautionary savings, where it's like, well, I've still got my job, but maybe I'll get fired next week. Maybe my company will fail next month. My spouse is unemployed, et cetera. So savings rates in the United States look like China. I mean, they've gone from 6% to 20%. In last April, it was 33%. So the problem is not money printing. And another way to understand it is, think of money printing as piling up wood. You pile wood, the pile gets higher and higher and higher, but it doesn't start a fire. You need a match, a lightning bolt. You need some catalyst for that. Well, then you have to say, what's the catalyst? Well, the answer is,
trigger? Yeah.
Well, it's psychological. But I do explain it in the conclusion of my book. So you're exactly right, Mark. The central banks are stuck. There's no way out. Money printing doesn't work. It only makes things worse in some ways. So the question is, how can they change behavior? How can central banks change inflationary expectations? How can they get you and I and our audience and your audience to say, oh, gee, the inflation's, I better buy a car, buy a house, go shop, get out of the dollar, get out of the euro, as the case may be. There's only one way to do it. You have to raise the dollar price of gold. And 2 presidents in the United States did this. Franklin Delano Roosevelt in 1933 and Richard Nixon in 1971. Now, Roosevelt did it on purpose. He knew what he was doing, and he was trying to get inflation because the problem was deflation. Yeah. And the idea of raising the price of gold, it's not to reward gold holders. It does. I mean, if you have gold, the price will go up. I expect gold to go to $10,000 to $15,000 an ounce in the coming years. But you have to do that. But the reason is not to reward gold investors. It's to get the price of everything else to go up, because the world of, I'll just say $5,000 to have a more, near term expectation. The world of $5,000 gold is also the world of $400 oil, $100 silver, $20 wheat. In other words, it gets everything else to go up. And that's why they do it. Now, central banks don't understand what we just talked about. They don't understand what I just said. They're supposed to, but they don't know what they're doing. So what I say in the end is, I said, look, if you're a central banker and you happen to be reading my book, here's how you can solve the problem. But if you're not, if the central bankers don't read it, and everyday people read it, you can do it yourself. You don't have to wait for the central banks. You can invest in some gold today, and you'll be ready for what's coming.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. we have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.